Hello, this is Brian Resney, President of Resney Wealth Management. I'm here to bring an important update about the economy and the investment market so you can better understand not only how we're currently positioned, but also what we see in the global landscape. A little bit about economic activity. Of course, we've had, the Hurricane Sandy that hit the upper East Coast, and there was obviously some pretty severe damage. This is ultimately going to help GDP in this country. Not a lot, but maybe 1/10 to 2/10 of a percentage point as we get into 2013 because of the rebuilding and the cleanup. That's actually a net positive. Storms like this, and we saw this when we had the tsunami, of course, in Japan last year, that actually helped their economy. I think this particular hurricane will help some of our economy grow just a little bit more in 2013. So I'm actually looking for a little bit higher GDP growth in the U.S. as we get into 2013. I think that's going to be a net positive. Position-wise, we are currently in, of course, still in emerging market bonds, which seem to be outperforming other fixed income, and preferreds, which appear to be outperforming most other forms of fixed income. We are avoiding right now any real long-term duration types of bonds, especially government bonds, and they're not even within our relative strength ranking on the top. They're actually at the bottom on the long-term bond, government bond. I've talked about this many times, not only in my updates weekly, but on my radio show and TV show. Investors ultimately don't understand really where the big risks are in the investment markets in the next 5 or 10 years. I firmly believe they're going to be long-term bonds heading south, meaning when rates eventually stabilize and even go up just a little bit, long-term bonds are going to get a hit. That's why, again, preference for us is preferred stock, and also emerging market bonds currently. I think those are two of the best opportunity income sectors there are next to or getting away from the risk of really long-term government bonds. On the equity-based side, we still own some equity-based sector ETFs within our portfolio, mainly emerging markets, and I believe emerging markets are going to be one of those areas as we get towards year-end here. And as we go into next year, I firmly believe the emerging markets have a good chance to outperform. And the reason for that is simple. Not only are they in the top rankings of our global tactical, and we do have exposure to those, but we added those in a few months ago. And the reason we did that is simple. Emerging markets underperformed most of the U.S. indexes up until a couple months ago. And then they started gaining a little bit of traction. They became relatively stronger against a lot of the U.S. indices. So they were added into our portfolio. Now, while emerging market sectors are, generally speaking, are still underperforming, have underperformed year to date the U.S., they're actually coming back from those doldrums. So ultimately, what becomes strong and gets weak wants to be sold out of the portfolio because that usually will give you underperformance. And areas that have underperformed that start to get relatively stronger are areas that get added back into the portfolio. I firmly believe as we see year-end coming, I think emerging markets will have a great tendency to outperform. And I ultimately believe in 2013, we have a very good shot that emerging markets, again, will be one of the big leaders because of their underperformance the last couple years. Emerging market economies in general contribute to about 70% of the world's growth. So think about where the U.S. was 80 years ago. Basically, those are the emerging markets today. Again, I look at the emerging markets as a great opportunity, and I think too many investors are greatly underexposed to that. Now, while we run a very strict investment strategy and our global tactical opportunity portion of our portfolio is currently in those emerging market bonds and emerging market equity-based investments, and we still own gold, I think there's a lot of investors out there, unfortunately, don't make those changes to a portfolio when necessary. Not every category will be risen when the tide goes up, and of course, ones that go down need to be sold. Weaker sectors historically have underperformed. Relatively stronger sectors are getting stronger, have historically outperformed over various time frames. When I look at the fixed income area especially, I'm starting to see that rollover of the high yield bond market. We have either greatly trimmed our exposure or completely gotten out of high yield bonds in general in the U.S. And the reason we've done that is I firmly believe high yield bonds are going to be one of the bigger risk categories going forward. And I believe if you've made money in high yield bonds, it's time to look at reducing exposure in that area. Remember, high yield bonds are very correlated to the equity market, and they typically go down when the equity markets go down. I look at yield spreads against treasuries and high yield bonds, and they're obviously the narrowest they've ever been pretty much in history. That tells me that high yield bonds, generally speaking, are fairly valued or overvalued. Just kind of a little tip for you out there who are not clients. Of course, if you're a client, you have a question about your portfolio, please call our office. We always like talking to you. If you're not a client and want to become a client, call our office for a consultation. We always like talking and taking on new clients who are nice people to do business with. Until Sunday's show, until tonight's TV show, make sure you have yourself a safe Halloween and a very profitable week.